Take a look at this chart. It shows us the proportion of total US GDP comprised of cash. We currently have 25% of all the value of the American economy stored away in cash. That's the equivalent to $7.5 trillion stored away on the sidelines doing absolutely nothing. This is the highest level since April of 2020, before that January of 2009, but it's also comparable to October of 2001. These dates mark three of the biggest economic downturns of the last 20 years, coinciding with the three largest stock market crashes of the last 20 years. Once these economic and market crashes came to an end, these mountains of cash that had been sitting on the side were then reinvested back into the economy, creating extended periods of economic stability with strong financial markets. Today we have two potential scenarios in the present day. Scenario A, institutional investors are currently sitting on the sidelines with a record amount of cash waiting for a crash to take place before redeploying all of this capital, just like they did back in 2001, 2009, and 2020. Scenario B, all of this cash is just about to get redeployed right now, which could lead to a complete flood of liquidity in financial markets and push us into a situation that we haven't seen since the 1920s. Today, the US job market has slowed to a complete standstill, with the last few months of data recording almost zero job growth in the US, and we've also seen the unemployment rate rise by a full percentage point over the course of the last year, both things that we also saw right at the start of the 2001 and 2008 recessions. So at a first glance, it might look like we're seeing scenario A happening all over again, that all of this cash sitting on the sideline is indeed just waiting for a crash to happen before getting redeployed. But to really understand what's happening, we need to look at exactly why financial institutions were seemingly able to hold a record amount of cash right at the moment where the economy was about to get rug pulled. By the way, the reason Bravos research exists is so that a maximum number of people can understand the broader macroeconomic dynamics that are at play and how you should be thinking about it as an investor or as a trader. We provide all of this research for free, and on our website at bravosresearch.com, we show you exactly how this translates into actual trades that we take, sending you live alerts each time we buy or sell an asset or stock. We've had a great year with lots of incredible trades so far in 2025, including Google, leveraged trades on precious metals, multiple trades on semiconductor stocks, and also trades on crypto. We are currently doing a Cyber Monday discount that allows you to get access to all of this for a fraction of the price. We never do discounts this big, and there's not much time left, so make sure you don't miss it. Now, you might be wondering, why are we trading AI stocks at a moment when the institutions that have historically been able to time major economic crises are now holding a record amount of cash? Well, believe it or not, financial institutions don't hold a record amount of cash because they have some kind of inside information regarding an impending economic crisis. It's really quite boring. They make their decision to hold cash simply based on how attractive the return on investment of cash is relative to the one of other assets. But it's not just financial institutions, it's everybody. When cash is very attractive, corporations, people, financial institutions are all incentivized to hoard more cash as they get the free interest rate that it provides. Now, the problem is that when this happens, it suffocates the rest of the economy. All of the money that could have been allocated towards expanding business operations, hiring new workers, investing in research and development, real estate construction, all of that capital is instead allocated towards cash just because it generates a great return on investment. This dynamic starves the economy of liquidity and increases the likelihood of seeing a downturn occur. This is precisely the mechanism that took place right in the lead up to the 2020, 2008, and 2001 recessions. This is the interest rate that you get for holding cash going back to the late 1990s. As you can see in these instances, it was quite elevated, meaning the return on investment of holding cash was high. And when we overlay the US inflation rate on top, we see that in each of these instances, in 2019, 2007, and 2000, right in the lead up to economic downturns, interest rate on cash was higher than the rate of inflation, which for the majority of the last 20 years was generally not the case. This created a real incentive for hoarding cash, starving the economy of liquidity and leading to the economic downturns and the market crashes that followed. Today we've been following the exact same playbook. The yield on cash was raised by the Federal Reserve in 2022 and 2023 and has been sitting well above the US inflation rate ever since. This has made cash an attractive investment, leading to the record cash accumulation that we covered at the beginning of this video, and has been slowly suffocating the economy and stagnating growth. So far, all of this corroborates with scenario A. It seems like this is just a repeat of what has happened before, and that we should be on the brink of seeing an economic downturn occur. But if we zoom in a little bit closer, we see that the situation is starting to shift. The interest rate on cash has been steadily falling for the last year as the Federal Reserve, the US central bank, has proceeded to cut their interest rate, making cash less attractive. Meanwhile, inflation has generally stayed stuck at around 3%. So what used to be a large gap between the interest rate on cash versus inflation has now very quickly shrunk. Not only that, but the Federal Reserve is projected to continue lowering their interest rate over the coming months down to 3% by mid-2026, which would potentially completely close this gap between the interest rate on cash and inflation. So cash is quickly going from generating a positive return on investment, which makes it a suffocating variable that is pulling away liquidity from the rest of the economy, to now becoming a useless asset that generates practically 0% return on investment to investors. And this actually turns cash into a fuel for the rest of the economy, with all of the money on the sidelines and all of the new money being created going into the financial system and the economy. If all of the cash on the sidelines actually begins to get redeployed back into the economic system, it would create a wave of liquidity, the likes of which we've only seen in the aftermath of the worst economic downturns. The worst part is that this would flood the financial system with money at a moment where the stock market has already been on its strongest multi-year run in decades, where gold and silver have also been melting up, and where crypto has grown by 500% just in the last 3 years. A flood of liquidity could potentially make all of this much more extreme. This is scenario B. Now, you might think that this is absurd and impossible, but believe it or not, it has happened before. We just have to rewind all the way back to the 1920s in order to find an example. Between 1923 and 1927, the US economy was structurally weak. Industrial production was stagnating, the real estate market was rolling over, the agricultural industry was also in trouble. In response to this weakness, the Federal Reserve cut their interest rate, so reducing the incentive to hold cash, in an attempt to stimulate economic growth. Between 1923 and 1927, the interest rate on cash dropped from 4.5% to 2.5%. This flooded the financial system with liquidity. The problem is, look at what was happening to the stock market between 1923 and 1927. The US stock market was in a complete melt-up. The lowering of interest rates in the 1920s was instrumental at creating the stock market bubble that popped in 1929. Eventually, the Fed had to step in and raise their interest rate to stop the rampant speculation, triggering the Great Depression. Today, the US stock market is on one of its strongest runs in history, and the Federal Reserve is being forced to cut interest rates in order to stimulate the real economy. This is a dangerous setup that could lead to rampant speculation in financial markets. If you've been following our videos for the last couple of years, you'll know that we've been making the case for this scenario B. I won't dive into the details here, but essentially the economy is weak enough to allow the Federal Reserve to cut interest rates, but just strong enough to allow financial assets to rise. And at a moment where profit margins are at record highs, this creates a backdrop for extreme speculation in financial markets to the likes of what we saw in the 1920s. Now, to be clear, we don't think we'll experience another Great Depression, and there's also many reasons why we think that, but this is a setup that will certainly produce a lot of pain when it unwinds. For now, as mentioned earlier, we're still riding the market higher because that is what the current macro story is telling us. It's even what the Fed is telling us. And you don't want to fight the Fed. Make sure not to miss the Cyber Monday discount on our service. There's not much time left, so if you want to have access to each and every trade that we take and know precisely the moment when we're going to exit this market, make sure to click the link down below. Thank you for watching.